When markets make wild moves, there's usually a message behind the madness. And this time, that message is coming straight from Donald Trump. In a fiery outburst, the president slammed Federal Reserve Chair Jerome Powell, calling him a major loser and demanding an immediate interest rate cut, or else he warns the US economy could hit the brakes. Just hours after the attack, Wall Street felt the tremors. The Dow Jones tumbled nearly 1,000 points, and red swept across the S&P 500 and Nasdaq. Is this a political pressure, market panic, or a sign of something bigger? Let's break it down. It's April 2025 and the US Federal Reserve is walking a tightrope. Inflation is still not fully under control, tariffs are pushing prices higher, and job market concerns are emerging. What's the Fed is doing about it, and how do their decisions ripple into your investments in the US, India, and around the globe? Let's find it out. In its March 2025 meeting, the Fed kept interest rates unchanged at 4.25% to 4.5% range, continuing its rate pause from January. But there's a twist. Federal officials raised their inflation forecast for 2025 and 2026, and they downgraded growth expectations for 2025. They still plan to cut rates by around 50 basis points this year, but that's only if inflation behaves. These trade barriers are expected to push the prices up, not just in the US, but globally. The Fed knows this. In their own words, inflation could be pushed higher this year because of tariffs. But how much higher? And how long? Even Fed officials admit there's a considerable uncertainty about it. You may be knowing that the Fed has two jobs: keep inflation in check and support unemployment. But now things are going tricky. Nearly all policymakers see inflation risks are tilted to the upside. Meanwhile, job market risks are tilting downward. That means high chances of rising unemployment. If the Fed keeps rate high for too long, growth could stall. If they cut rates too soon, inflation could surge again, especially with global goods getting pricier due to tariff. So what does all this mean for your investments? Equity markets volatility will remain. Any surprise in inflation or Fed signals can jolt the market. Bonds yields are attractive right now, but if the Fed cuts later this year, long duration bonds could gain. Otherwise, debt funds and bonds may generate a muted return. Dollar strength. High US rates keep the dollar strong. That puts pressure on emerging markets like India, causing capital outflows. Gold and commodities. These may stay resilient due to tariff driven inflation concerns. In short, balance is key. Consider a mix of quality equity, short to medium term debt, and global diversification. Here's what the policy rate projections are for the US Federal Reserve. By late 2025, Fed fund rates could fall to 4.25%, and by 2026, around 3.5%, and by 2027, it could come down to 3.25%. But that all depends on how inflation evolves, whether trade tensions settle or worsen. One thing is clear: this isn't one way street. Global policy, trade wars, and domestic economics are all playing a role. In today's world, monetary policy isn't just for economists, it's the backbone of our investing decisions. Follow us for more insights on global finance and smart investing.